Is $7 billion tender a warning? OpenAI's exit plan could backfire. OpenAI's $7 billion liquidity risk demands that you protect your capital growth and build sustainable AI economics. OpenAI's reported $7 billion employee tender at an $852 billion valuation solves a real liquidity problem. But you should ask whether shareholder liquidity is competing with AI growth capital. The $122 billion March financing strengthened OpenAI's balance sheet, yet the $7 billion tender equals roughly 5.7% of that capital, highlighting a meaningful capital allocation trade-off. OpenAI reportedly spent $34 billion during 2025, including $19 billion on research and development and $6 billion on sales, marketing, and other operating expenses, exposing enormous capital intensity. The first quarter of 2026 delivered $5.7 billion revenue alongside approximately $3.7 billion cash burn, reminding you that rapid AI revenue growth can still consume extraordinary amounts of capital. The real concern is not employees monetizing equity. It is whether an $852 billion private valuation remains a credible capital allocation signal when frontier AI requires sustained external funding. Carta's 71 tender offers worth $3 billion during the first half of 2026 show that private market liquidity is becoming a structural financing mechanism rather than an isolated corporate transaction. OpenAI's confidential S-1 submission in June gives management IPO flexibility, but you should recognize that optionality does not eliminate valuation risk, dilution risk, infrastructure risk, or funding pressure. L-Impact Solutions argues that liquidity is not profitability. A tender solves employee ownership concentration while leaving revenue quality, operating expenditure, compute requirements, and free cash flow economics fundamentally unresolved. The valuation anchor problem deserves scrutiny because the $852 billion figure came from a negotiated $122 billion financing round, not continuous public market price discovery across changing competitive and economic conditions. You should focus beyond headline revenue and examine contribution margins after inference costs, model development, infrastructure commitments, energy requirements, and employee compensation before assuming AI scale automatically creates value. Management should separate employee liquidity budgets from core growth capital, linking tender limits to free cash flow, cash runway, and committed infrastructure spending instead of employee demand. Every major AI investment should connect revenue growth, gross margin, inference cost, customer acquisition cost, compute utilization, recurring revenue, capital expenditure, and free cash flow into one economic framework. OpenAI should maintain 3 operating scenarios covering sustained demand, moderate normalization, and adverse conditions involving lower pricing, stronger competition, or slower enterprise adoption, with explicit spending thresholds. IPO readiness should become an operating discipline, with public company-grade financial reporting, internal controls, governance, risk management, related party oversight, and capital allocation processes built before market timing forces action. An $852 billion valuation should undergo stress testing against revenue multiples, gross margin assumptions, free cash flow scenarios, compute cost trajectories, and competitive pricing pressure rather than becoming an unquestioned strategic benchmark. After a large tender, OpenAI should protect retention through refresh grants, performance-linked equity, and transparent vesting policies, because employees selling significant equity may otherwise perceive reduced future upside. NVIDIA's August 10th announcement of platforms targeting more than $500 billion in third-party AI infrastructure capital shows financing is expanding beyond conventional venture funding, but dependence still needs discipline. L-Impact Solutions recommends an AI unit economics committee that challenges every major capacity commitment through utilization, revenue contribution, payback period, and downside exposure before approving infrastructure expansion. Prevention requires quarterly stress testing at 20%, 30%, and 40% valuation compression, alongside a protected liquidity reserve covering compute contracts, data centers, payroll, research, and adverse revenue scenarios. The broader lesson is blunt. Private liquidity can postpone an IPO, but you cannot postpone economic discipline. Durable AI winners must convert capital intensity into sustainable cash-generating advantage. Can OpenAI's $7 billion liquidity move hide a deeper cash burn crisis? Comment your answer below. For more analyses, visit our consultancy website. Link in description below. Thank you.